Now, going back to a other question that came in, Bill said, do you ever use charts to guide you? Yes, I use the market sentiment tool. That's why I started buying married puts when we saw the very bullish buys. But when I got into NEM, Newmont Mining, sorry, I don't want to sound like NEM again. I'm sorry, I'm going to change this back. Did I still have it up? No, I have Apple up. I want to do a 1 month. Let me draw the chart. What do I have selected here on my chart build? This is saved. This is what I use when I'm trading on my account. We're on the webinar account, but the cookie is saved here for the chart. So when I link over, seeing the same thing. What are we looking at? MACD, SMA 20, Bollinger Bands. I got into this position, excuse me, on the 30th. When I saw what? When I ran my search, I was looking for stocks that were above the SMA 20 and had a recent MACD crossover within at least a day. I wanted to see this movement. That's why I bought into this position at the time. I'm going to say I managed it correctly. I've only been in it for 7 days. I got a lot of time to manage this position. Again, you see a position here. This would have been a time maybe to sell out of the position. Of course, it's declining. It was a little bit of a late of a signal. But here, there's a positive crossover. Not a bad time to buy as well. But then when you started to see it coming back, it was probably time to sell. I look for MACD. I do. RSI is more of a tertiary indicator. I'm looking for SMA 20, maybe a Bollinger Band or something that's riding the Bollinger Band. Yes, this is only a 1 month chart, so we're not seeing further examples of it. Let's go back to the 3 month chart. So the MACD crossover probably occurred way before this, but when you start to see a positive MACD crossover here at about 44, is that a good time to buy? Not necessarily. It moved up. It's withstood, and you could sell calls, you could generate income, but we're not talking about a lot of movement here. Let's go to 6 months. I'll pull up ANET in a second. There we go. Where are we back to 6 months in time? Back into May and June? Yeah, well, that's when the market started to go iffy. Negative MACD crossover. What are we seeing here when the stock was above 85? Now, am I thinking the NEM is going to go back up to 85 where it was in June before things started to collapse in that 4-day period we talked about? No. But this would have set a perfect signal to say, hey, get out of this position now if you're in it. All right, close it at 80. Get out of it. Or buy puts, not married puts, but just buy puts. Would have worked out really, really well. Saw some fake signals in here. This one was kind of decent, but it wasn't great. This one started to look like it was better. This was the 52-week low, remember, too. That was another reason why I bought it. So the chart is guiding me, in a sense. That's what I use. This is what Ernie uses, too. His charts are set up very similar. If you get a coaching session with Ernie, you say, hey, how would you set up big charts? You're going to see something very similar to what you saw when I first linked over to this position. Bollinger Bands, SMA 20, MACD, RSI, volume. He might use another indicator that I'm not. I forget which one. ANET, when I got in on October 4th. What I like about the ANET position, by the way, this is going to be in that members-only presentation. It's in those slides that I was putting together. Oh, I'm sorry. Let me go back to 10 days or 1 month. Let's do 1 month so we don't have to change our frequency. October 4th. What have I got? Positive MACD crossover. Jumping above the SMA 20 in those cases, and nowhere near the 52-week low of 89.15, but was near a recent low of about 110. Okay, I got it at 120 here, but it's near the high. So I'm flirting with a stock that's only 20 points away from its high as a $120 stock. It's back down to 116. I think it could easily test 112 or 110 again, possibly, depending on what happens next week. Am I worried about that? No, because what's going to increase as the stock falls? My put. I'm not going to be near the maximum loss. I could move that down, adjust the put. That's another way to move the put as well. Tom does say you found the 20-day moving average break above or below the best and use MACD or stochastic for the exit. MACD is also an exit for me as well. When I see that negative crossover, but in a married put, it's different. Okay, if I'm in a bull put credit spread, you've seen me say those on the webinars, I'll use MACD as a close to exit the position on a bull put credit spread. On the married put, if I see the MACD go negative crossover, that's when I might start considering preparing for an income method number 9 or an income method number 12 in the blueprint to potentially profit in both directions. So Bill, I do use the chart to guide me. There's discussions on that in other strategies, bull put credit spreads and so forth, when we talk about what we look for in those cases. Now, Scott, I apologize. Your question was more related to the Apple discussion. You said, what if you're expecting a drop of 15%, but it didn't to suffer further loss? Could you go out of the money for a married put? Well, you wouldn't have as much protection as an in-the-money put that we discussed. So, for example, let's just keep the June example first. And a 15% drop. I'm sorry, folks. There we go. I could do it in my head, but last two Fridays I did that after 5 o'clock. I did it in my head there. I got it wrong. Let's see here. I'm sorry. So anyway, 140 stock. I apologize. 21 points. So we're down to 119. Let's say in the next 30 days, the stock drops to 119. 15% drop, Scott, that you mentioned. And again, happy Halloween, October 31st. So remember, my maximum loss was 1,006 or 6.3%. The put, we'd expect to go up about 1,200 points to 32.17 based on Black-Scholes pricing and current volatility. So we'd be losing, let's call it 890. Okay, so 890 off of our total investment, in this case, of 1,606.50. So yeah, we're going to be close to that maximum loss, but not quite. 890 and 1,6006.5. It's a 5.5% loss on the position, close to the maximum loss, with a 15% drop from where we are. Now, what if instead of the in-the-money put for June, I did the out-of-the-money put that was cheaper? Let's do the 130. It was half the price, close to it. Well, yeah, it's half the price, a little bit more, but we're going to stick with the June 130 that we worked for in that other example, Scott. And of course, our risk is 13.8%, 2,089. And if we drop to 119, 15% in 30 days, making sad jack-o'-lanterns and pumpkins as we're looking at our loss, we're down 1312. So an additional $420 loss on this position. And on our cost basis, a loss of 1312. And I'm sorry, my effective cost was 15 lower. You're looking at an 8.6% loss on this position now, as opposed to 5.5% with the in-the-money put. Let's go cheap. Let's go to November standard, 42 days out in time. We'll go with the 130 put that's only $4. That's great. 9.8% maximum risk, or $1,400. And if we drop down to 119 on October 31st, thank God it held, that's great. And we're down $1,300, pretty close to the same thing. Because the stock had to drop to 130 first before the insurance kicked in. It's not at full loss, but remember, our cost basis was lower at 14,409. We're still losing $1,300, or 9% on the position. That's the biggest percentage loss of investment, is going shorter term, cheaper. You say, what is the difference in cost of the put? Do we save anything? Not really, because remember what I said. Going out of the money in this case, the stock needs to fall before the insurance kicks in. And when you go shorter term, you're going to be closer to the maximum loss on the position if the stock falls in that expectation. You saved money buying the put because you only put up $4, but it costs you to lose more because it's shorter term. It's going to quickly go right to intrinsic value if it drops, and the percent risk was higher than the in the money put further out in time, 6% versus 9.8%, and you're close to that maximum loss. The out of the money put, you only paid 50%. You paid $10.80 instead of $20.10 for the 130 June put versus the 150 put. But we're already in the money, so when the stock falls, we have a higher delta. We make more back on the put. With the out of the money put that was half the price, you saw we were losing $1,300 instead of $890, or down 8.6% instead of 5.5. That's just how it works. That's the disadvantage of out of the money puts, even though they are cheaper. And that is why, of course, as I keep saying in the blueprint, we teach to go 1 to 2 strikes in the money. Don't want to go more than 20% in the money, because then your expectancy of profit is too low. There is such a thing as too little risk. But the proper structure, controlled risk, taking advantage of the at the money bell curve, that's what we were looking for. Oh, Bill, great question. I should have followed this up. This has gone, I don't know if I'm going to crop this whole thing up or just leave it together in discussion of married puts here. I love the discussion, guys, but I know we've bounced back to Apple, and we've bounced back to in the money, out of the money, and we talked about chart reading. And Bill says, is there a fundamental reason for NEM and ANET? All right, I'd have to do it. I have to give you all a preview, even if you're not blueprint owners or anything else. And this isn't giving any kind of the farm away or anything along those lines, but let's go back here. Oh, wrong one. I apologize. Oh, I messed it up. I'm sorry. You'll see what I mean by messed it up. Okay. All right, so I'm just going to do it this way to give you a free preview. It's not the full presentation. I'm not even all the way through it yet, but let's go ahead and do it now that we're at this point. All right, starting a married portfolio, where to begin, what approach to use? Well, let's say that we're starting from scratch. We're all in cash, $50,000, $100,000 portfolio. How are we going to start opening married put positions? Should I open 5 to 10 trades at once? How many shares or contracts of each? Common questions. Hey, well, that's all talked about, of course, in the blueprint itself. Chapter 4 of the all-electronic version talks about what is the suggested maximum loss. You guys just saw that in the 10 minutes, 20 minutes I just spoke about it. And rules of thumb, which include a loss limit to the portfolio and a loss limit for each individual stock position. All right. The last open married put I had in the radioactive trading portfolio was Starbucks that was closed on September 12th. And I didn't open new positions until September 30th. Why the 18-day delay? I'm going to go through this fast because this isn't the full presentation. Ernie was still active on his married puts. He also opened Stride Learning, LRN, on September 30th. Why did I wait so long after closing the Starbucks position? Again, as I mentioned, I was waiting, got the very bullish buy signals on 929 and 930 for the market sentiment, and that's when I thought was a good time to get into NEM and ANET. I was getting into 2 new married puts to answer the question, Bill. But how to work it? Did I jump into, am I going to jump into 5 to 10 trades at once? Even though I did 2 in 3 days, no, I'm going to spread the funds out over time. I'm going to look to invest about 20% of the total portfolio each month. And the blueprint discusses how many shares or contracts we should use, because I want the total monetary risk on each married put position to only be 1 or 2% of the total portfolio. How do we know which stocks to use? The married put is a bullish position. We're going to look for bullish stocks, but 95% of the trades we open in the Fusion portfolio come directly from the search tool and power options or the RPM report in those cases. They're just on the Fusion subscription, okay? Sorry. So where am I going with this? Don't need to read this. Why spread it out and use just over 20? That's, more discussion then. But how did we begin on September 30th? I started with the search tool and power options. And I went to the RPM report for or same thing would have been on the Fusion subscription. The 3 that came up, there were 4 that came up during the day on September 30th when it started triggering the very bullish buy. Remember, the market was still going down. It closed at 3585. SPX closed at 3585, the lowest it had been. PDD, Stride, which Ernie got, and I liked BJ's. And I still might consider BJ's down the road. What was I looking for? I was looking for consumer defensive, in a sense, and I was looking for industries where I felt would show growth now that we've been near this bottom. And I decided, okay, I like the fourth one. I can't remember. Oh, it was lithium. It was not called lithium. It's the symbol is LTHM, Livent Corporation, which does lithium EV batteries. Volatile, and the risk was too high, 9 to 9.5% on the search. So I was looking at BJ's. But then I have another search I like to run. And what that looks at occasionally is for stocks that are trading above their 20-day moving average, higher open interest and current volume, and have had a positive MACD crossover in the last 2 days, just like we talked about letting the chart guide me. I ran that search, and I see things such as Coherent, GlaxoSmithKline, Las Vegas Sands, Consumer Cyclical. I'm not sure if that's what I want. Resorts and casinos in this market. Stride is in there again that Ernie got into. SSR Mining, and then NEM. So I decided on the 30th to go the 5% of the Fusion trades the trades that I opened for the Fusion portfolio that are not directly from the search. They mostly come from this search and one other search that I use for dividend paying stocks after a big decline. Things like Johnson & Johnson, Crafts, and so forth. But in any case, it's a bullish structure. This is just a bullish screen that I've created. And I saw the two basic materials in gold. Pan American Silver was another one that was up during the day on this search, and that's one I could have gotten. It was like a $14, $15 stock, same as SSR. I think Pan American Silver went up higher, but then came down further in those cases. But I thought gold and silver after that move were going to be a good one to get into, and I included that in the brief when I posted the trade for Newmont Mining. Brief, why Newmont Mining? Wanted to go into defensive cyclical. BJ still looked good. I thought the sentiment materials were going to start rebounding, gold and silver specifically, copper as well. I didn't take the exact trade that came up for the search. I used the search by symbol and analyze other expirations. I'm sorry, let me go back one. You see in the search here, our Newmont Mining was the January 50 with a risk of 7.7%. That was still acceptable. It's further in the money. So almost 20% in the money, still an acceptable risk. But I really wanted to stay closer to 45, and the 45 risk here was 10.4%. So I made a choice because I was looking for a fast rebound based on the market sentiment and my expectations. I looked at March. I found the 45 with a 7.4% risk. I saw an upward MACD SMA crossover coming off a 52-week low. It seemed like a smart and reasonable trade for me to get into. If I'm trusting the market sentiment, thought the market was going to be bullish, and it had the trends that I wanted. So that's a shorter view, and then here's just the bigger view of that. And, that's what I was looking for with that position. Now, let me clear out the drawing. ANET was very similar. This came directly from the search on October 4th, running the default married put search sorted by earnings per share growth. Texas Roadhouse. I like the risk on this one, and I like the position, but restaurants and casinos, I'm just not sure of. BJ's is there. Advanced Drainage Systems, WMS, don't know them that well. And I see Arista. And a 120 stock, 125 March put, 8.2% risk, but being just 3% in the money. Technology has been hit hard, and I admitted that was a risk in the brief for the Fusion subscribers. But I figured even if it just stagnated, I could still get good premium for the 125 calls to start knocking down that risk. I haven't yet. I should have done it 2 days ago before the big decline today. It's down to 116. But like I said, I still like the position that I'm in there for ANET. And when I opened it on the 4th, as you saw earlier, similar chart. Positive MACD crossover within 1 or 2 days above the SMA 20, coming off of a near recent bottom around 108. Probably would have been the better price to get in, but I didn't see the signals I wanted at that price, and it wouldn't have come up, my apologies, in the search. So there you go. 95% of the Fusion portfolio positions are open directly from the main search there. The other 5%, well, like I said, it's a neutral to bullish strategy in those scenarios. So any type of criteria you use for a neutral to bullish strategy, that will work. And at the same time, just remember you want to be at least 150 days out in time. You don't want to go too deep in the money, and you want to have the controlled risk on the position. Yes, for you Fusion and subscribers and Blueprint owners, there's going to be much more to that conversation. I rifled through that very quickly because it did answer the question, but I'm not giving anything away for free, just kind of showcasing what is coming up there.